All right, let's dive right into this explainer and tap into that universal urge we literally all share, wanting to know exactly how our financial standing stacks up against everyone else's. We all kind of wonder if we're ahead of the curve, fallen behind, or right on track, don't we? Well, today we're going to explore the traditional ways people have measured wealth, uncover some massive flaws in those old school formulas together, and then discover a really empowering metric you can calculate right now to chart your own path to financial independence.
Here is our roadmap for today. 1. The wealth comparison game. 2. Are you a PA? 3. Flaws in the formula. 4. The 25x rule. And finally, 5. Your path to FI. Let's get to it.
Section 1. The wealth comparison game and establishing a baseline for your finances. Before we start crunching our own numbers and projecting into the future, we have to get on the exact same page about what metric we're actually measuring. So the absolutely crucial point here is that when we talk about wealth in this explainer, we are talking strictly about net worth. As institutions like Chase and Fidelity define it, your net worth is simply a snapshot of what you own minus what you owe. Your assets are things like cash savings, retirement accounts, and the market value of your home. Your liabilities, those are your debts, credit card balances, student loans, your mortgage, all that stuff. Notice we aren't talking about your salary here. A person with a lower salary can actually have a high net worth if they own assets outright, while a super high earner could be drowning in debt and have a negative net worth.
Now, if we pull data from the Federal Reserve, we see two numbers for every age group, the median and the average. I highly recommend you focus entirely on the median, which represents the true middle of the pack. You really want to ignore the average net worth because it's heavily skewed upward by households with absolutely massive wealth, the billionaires of the world. Just as an example, for ages 35 to 44, the average is nearly $550,000, but the median, it's a much more grounded $135,000.
Moving right along to Section 2. Are you a PA? Let's look at the traditional formula for wealth.
Seeing those national baselines naturally makes you wonder where you personally fit into the grand scheme of things, right? It's one thing to be average, but what if you want to be exceptional? How much should you have saved by your current age? Well, to answer that, we can look at a very famous benchmark from the personal finance classic book, The Millionaire Next Door. It's been a staple in wealth-building philosophy for decades.
The authors of that book created a highly specific category for the absolute best savers. They called them prodigious accumulators of wealth, or PAWs for short. The whole idea was to create a formula that stripped away the flashy facade of wealth, like, say, driving a leased luxury car you can't really afford, and looked purely at how efficiently a person turns their income into real, lasting net worth.
So how do you see if you make the cut? The math is actually pretty simple. You take your age, multiply it by your realized pre-tax annual household income, and divide that number by 10. That result is what they call your expected net worth. If you have double that amount, boom! Congratulations! You are a prodigious accumulator of wealth. But if you fall below that expected mark, well, the traditional old-school advice suggests you just aren't saving enough and seriously need to tighten your belt.
But hold on a second. Section 3. Flaws in the formula. It's time for a reality check from the community. While this PAW formula is incredibly famous, if you spend any time in the financial independence community on forums like Reddit, you'll quickly realize it has some massive, glaring logical gaps. Here's the first huge problem. One user perfectly pointed out that because the formula relies so heavily on your current income, it literally punishes you for succeeding in your career. Imagine you successfully negotiate a massive raise today. Your target net worth instantly skyrockets overnight, making it look like you are suddenly a terrible saver, even though your actual bank balance didn't go down a single cent. Make it make sense, right?
That brings us to a second major flaw. The math expects a linear accumulation of wealth. It just assumes your wealth is going to grow in this perfectly straight, steady line. But as any financial advisor will tell you, true wealth is built exponentially through the absolute magic of compound interest. In your early years, your wealth grows slowly, but in later decades, that growth curves dramatically upward. This formula completely ignores the reality of compounding.
Ultimately, it creates a wildly inaccurate and, frankly, super demoralizing standard for young earners who are just starting out. Someone on a UK financial forum ran the numbers and pointed out that, according to this formula, a 21-year-old earning minimum wage should somehow have a net worth of nearly £42,000. That is literally more than they've likely earned in their entire working life. Actually, scratch the PA formula entirely unless you're in a very narrow age band nearing the end of your career. It just doesn't work for most of us.
So what do we use instead? Section 4, the 25x rule.
which is a vastly superior alternative.
If focusing on our income to calculate a target net worth is fundamentally broken, the financial independence community offers a brilliant pivot. We are moving away from the old school thinking, which targets your wealth based on what you earn, to a highly tailored goal based purely on what you spend. Think about it. If you make $1 million a year but spend $1,000,001, you're still broke. Your wealth target absolutely needs to be anchored to the lifestyle you actually want to maintain.
To really grasp how this works, we turn to the famous 4% rule. Davenport and Associates explain this using a fantastic cookie jar analogy. Imagine you have a giant jar holding $1 million. Every year you take out 4%, which is $40,000. But because your money is invested and historically earns around a 7% average return, the cookies actually keep baking. The jar replenishes itself. Studies show that if you stick to that safe withdrawal rate, your money can last 30+ years, surviving inflation and wild market wobbles. To calculate your exact financial independence number, or FI number, you just use the inverse of that 4% rule. It takes two incredibly simple steps as outlined by the folks at Choose FI. First, figure out your total annual expenses. Second, multiply that number by 25. That's literally it. That is the exact size your cookie jar needs to be to sustain your lifestyle indefinitely.
All right, let's bring it all together. Section 5, your path to FI, and making the math work for you. It is so empowering to finally put real dollar amounts to these theories, isn't it? Instead of stressing over some arbitrary target based on your age and salary, you now have a highly specific, customized goalpost. When you break down these safe withdrawal rates, you see exactly how it scales. If your lifestyle only requires $20,000 a year, a $500,000 portfolio means you are completely financially independent. If you want $120,000 a year, you're going to need a $3 million portfolio. It's simple, clear math that scales directly to your chosen standard of living.
So, the million-dollar question, how do we get there faster? Whether you look at the Chase framework or Choose FI strategies, the levers are essentially exactly the same. You aggressively pay down high-interest debt to kill off those liabilities, you automate your savings, you invest wisely to catch those compounding returns, and you constantly look for ways to boost your income while slashing your expenses. And remember the absolute beauty of the 25x rule. Dropping your expenses is a total double win, it frees up more cash for you to invest right now, and it permanently shrinks the total FI number you actually need to hit your goal.
So I'm going to leave you with this one final thought to chew on. Are you currently evaluating your wealth by what you earn or by what you actually spend? It might be time to stop stressing over old, flawed formulas that literally punish you for getting a raise. Focus on what you truly value and start building your own personalized path to financial freedom today.